about terminologies that traders must know. In this video, you will learn bid and ask, volume, liquidity, leverage, margin, stop loss, and take profit. Let's start. First up, we have bid and ask. Imagine you're trading stocks. The bid represents the highest price a buyer is willing to pay for a stock, let's say $50. On the other hand, the ask represents the lowest price a seller is willing to accept, let's say $51. The difference between these prices, in this case $1, is known as the spread. Next, we have volume. Volume refers to the total number of shares or contracts traded for a particular financial instrument within a given time period. It is a measure of the activity or liquidity in the market. Volume is often represented as a bar or line chart alongside price data. For example, let's say you are looking at the trading activity for a stock on a specific day. The volume for that stock shows the total number of shares that were bought and sold during that day. If the volume is high, it indicates a high level of interest and trading activity in that stock. Conversely, if the volume is low, it suggests a lower level of interest and less trading activity. Here's an illustration to help clarify. In this example, the volume column shows the number of shares traded at each specific time interval. For instance, at 9:30, a total of 10,000 shares were traded. As the day progresses, you can see the changes in the volume and analyze the level of activity and liquidity in the stock. Volume plays a crucial role in technical analysis as it helps traders and analysts interpret price movements. Higher volume often accompanies significant price changes, indicating strong market participation and potentially signaling a trend. On the other hand, low volume may suggest limited interest or lack of conviction among traders, making price movements potentially less reliable. Liquidity plays a vital role in trading. It refers to the ease with which an asset can be bought or sold in the market without significantly impacting its price. A liquid market has a high volume of trading activity and a large number of participants, resulting in narrow bid-ask spreads. When a market is highly liquid, it means that there is a substantial number of buyers and sellers actively trading the asset. This allows traders to enter or exit positions quickly and at a fair price. On the other hand, illiquid markets have lower trading volumes and fewer participants, making it harder to buy or sell assets without affecting their prices. To understand liquidity better, let's consider an example. Suppose you are a trader looking to buy or sell shares of a particular company. Let's call it ABC Inc. If the shares of ABC Inc. are traded on a major stock exchange with high trading volumes, such as the New York Stock Exchange, and there is a large number of buyers and sellers actively trading those shares, the market for ABC Inc. stock would be considered highly liquid. In a liquid market, you can place an order to buy or sell ABC Inc. shares, and there would likely be enough counterparties willing to trade with you at a price close to the prevailing market price. The bid-ask spread, which represents the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, would be relatively narrow. Conversely, if the shares of ABC Inc. were traded on a smaller exchange with low trading volumes and fewer participants, it would be considered an illiquid market. In this scenario, it might be more challenging to find buyers or sellers for the shares, and executing trades could result in larger bid-ask spreads or delays in finding counterparties. In summary, liquidity in trading refers to the ease of buying or selling an asset without significantly impacting its price. Highly liquid markets have high trading volumes, many active participants, and narrow bid-ask spreads, making it easier to execute trades at fair prices. Illiquid markets have low trading volumes, fewer participants, and wider bid-ask spreads, making it more challenging to buy or sell assets. Leverage empowers traders to control larger positions in the market with a relatively small investment. By using leverage, traders can amplify their exposure to the underlying asset and potentially magnify their profits or losses. Here's an example to illustrate leverage in trading. Let's say you have $10,000 in your trading account and you want to invest in a particular stock. Without using leverage, you can only buy $10,000 worth of shares. If the stock increases by 10%, you would make a $1,000 profit, 10% of $10,000. However, if you decide to use leverage, let's say your broker offers you a leverage ratio of 1 to 5. This means you can borrow an additional $40,000, 5 times your initial capital, to invest in the stock, making your total position size $50,000. With the increased leverage, if the stock again increases by 10%, your profit would be $5,000, 10% of $50,000, instead of just $1,000 without leverage. However, it's important to note that leverage not only amplifies potential profits, but also potential losses. If the stock price goes down instead of up, and let's say it decreases by 10%, your loss would also be magnified. Without leverage, you would lose $1,000, 10% of $10,000, but with leverage, you would lose $5,000, 10% of $50,000. Leverage can be a powerful tool for traders to increase their potential returns, but it also comes with increased risk. Margin. Margin refers to the amount of funds or collateral required by a broker to open and maintain a leveraged position. It allows traders to control a larger position size with a smaller amount of capital, as the broker lends them the remaining funds to enter the trade. When a trader opens a leveraged position, they are required to deposit a certain percentage of the total position value as margin. The required margin is typically expressed as a percentage, known as the margin requirement or initial margin. The remaining funds are provided by the broker as a loan, known as leverage. For example, let's say you want to buy $10,000 worth of shares of a company, and your broker offers a leverage ratio of 1 to 5. This means that you would need to deposit $2,000, 20% of $10,000, as margin, and the remaining $8,000 will be provided by the broker as a loan. Margin allows traders to amplify their potential returns by controlling a larger position. However, it's important to note that while leverage can magnify profits, it also increases the risk of losses. If the trade moves against you, losses will also be amplified. In addition, we also need to mention margin call. A margin call occurs when the account value falls below a certain threshold, known as the maintenance margin. The maintenance margin is a percentage of the account equity, the value of the account after accounting for profits or losses. If the account equity drops below this threshold, the broker will issue a margin call to the trader. When a margin call is issued, the trader is required to deposit additional funds into the trading account to bring the account equity back above the maintenance margin level. Failure to meet the margin call may result in the broker automatically closing out the trader's positions to recover the borrowed funds. Let's continue with the previous example. Suppose the maintenance margin level set by the broker is 50% of the account equity. If the value of your position drops to $7,000 and your account equity falls to $1,500, below the 50% maintenance margin level, a margin call will be issued by the broker. You will then be required to deposit additional funds to meet the margin requirements. Margin calls are designed to protect the broker from potential losses and ensure that traders have sufficient funds to cover their leveraged positions. They serve as a risk management mechanism to prevent excessive losses and potential default. Traders should closely monitor their margin levels, account equity, and market conditions to avoid margin calls. Proper risk management techniques, such as setting appropriate stop-loss orders and managing leverage responsibly, can help traders avoid margin call situations. Then, the last part is about stop-loss and take-profit. Stop-loss and take-profit are two common orders used in trading to manage risk and set predefined exit points for a trade. They are typically used to automate the process of closing a position when certain price levels are reached. A stop-loss order is placed to limit potential losses on a trade. It specifies a price level at which the trade will be automatically closed to prevent further losses. It is designed to protect traders from significant adverse price movements. For example, suppose you buy shares of a company at $100 per share and you set a stop-loss order at $90. This means that if the stock price drops to or below $90, your position will be automatically sold, limiting your potential loss to $10 per share. Stop-loss orders help traders control risk by defining the maximum amount they are willing to lose on a trade. They are particularly useful in volatile markets or situations where a trader may not be able to actively monitor the market at all times. A take-profit order is placed to secure profits by automatically closing a position when a specified profit level is reached. It allows traders to lock in gains without having to constantly monitor the market. For example, let's say you buy shares of a company at $100 per share and you set a take-profit order at $120. If the stock price reaches or surpasses $120, your position will be automatically sold, locking in a profit of $20 per share. Take-profit orders help traders capture profits when they believe the market has reached a favorable level. They are especially useful when traders cannot actively monitor the market or want to secure profits without emotional bias. Both stop-loss and take-profit orders can be placed simultaneously when entering a trade. They allow traders to define their risk-reward ratio and implement a systematic approach to managing trades. In conclusion, as a trader, it's important to be familiar with key finance terms that we have talked about. These terms help you analyze the market, make better trading decisions, and reduce risks. Master these concepts, and you'll be on your way to achieving your financial goals. Thanks for watching. If you liked this video, be sure to hit that subscribe button and turn on notifications so you never miss a video.